Here are the important terms that you should know when buying a life insurance. More of that after our introduction. For you to receive free finance videos, don't forget to like, comment, share and subscribe to this channel to get free 100 pesos worth of Gcash. Available only in the Philippines. The following are the important insurance terms. 1. Contract of insurance. 2. Insurable interest. 3. Incontestability clause. 4. Elimination period. 5. Grace period. 6. Premium. 7. Insured. 8. Beneficiary. 9. Irrevocable designation. 10. Concealment. Number 1. What is contract of insurance? A contract of insurance is an agreement whereby one undertakes for a consideration to indemnify another against loss, damage or liability arising from an unknown or contingent event. Where there was no perfected contract of insurance, the insurer cannot be held liable on the contract that does not exist. Number 2. Insurable interest in life insurance. Insurable interest in life is the interest which a person has in his life, or the interest which he may have in the lives of other persons on whom he depends wholly or in part for education or support, under legal obligation to him to pay money, to deliver property, or to render service, upon whose life any estate or interest vested in him depends. Number 3. Incontestability clause. The incontestability clause serves a noble purpose, as it regulates the actions of both the insurer and the insured. An insurer is given 2 years from the effectivity of a life insurance contract and while the insured is alive to discover or prove that the policy is void ab initio or is rescindable by reason of the fraudulent concealment or misrepresentation of the insured or his agent. After the 2-year period lapses, or when the insured dies within the period, the insurer must make good on the policy, even though the policy was obtained by fraud, concealment, or misrepresentation. Sun Life vs. Sibia, 793-45, Number 4. Elimination period. An elimination period is the length of time between when an injury or illness begins and receiving benefit payments from an insurer. Also known as the waiting or qualifying period, policyholders must, in the interim, pay for these services. The resulting effect can be thought of as a deductible. Investopedia.com. Number 5. Grace period. Grace period is a period of 30 days given to the insured who failed to settle his or her outstanding premium, during which period, the insured is still covered with life insurance. The insured must settle his or her outstanding premium within the grace period in order for the policy not to lapse. Number 6. Premium. An insurance premium is the consideration paid an insurer for undertaking to indemnify the insured against a specified peril. The premium, also called the gross premium, consists of 2 parts, the net premium which is the sum paid periodically to meet the cost of the insurance and carry it from period to period, and the loading rate which answers for administration, management, operating expenses and profits of the insurer. Number 7. Insured. Any person with capacity to contract and having an insurable interest in the life or property insured may be the insured. Number 8. Beneficiary. It is the person designated to receive the proceeds of the policy when the risk attaches. It is obvious that the only persons entitled to claim the insurance proceeds are either the insured, if still alive, or the beneficiary, if the insured is already deceased, upon the maturation of the policy. Number 9. What are the effects of an irrevocable designation of a beneficiary under the Insurance Code? If the designation of beneficiary is irrevocable, the insured cannot assign the policy, take the cash surrender value of the policy, allow his creditors to attach or execute on the policy, add a new beneficiary or change the irrevocable designation to revocable, even though the change is just and reasonable. This is so because the irrevocably beneficiary and his heirs have acquired from the date of the policy vested rights over the policy. Philam vs. Pineda, 175-416, Number 10. Concealment. Concealment is a neglect to communicate that which a party knows and ought to communicate to the other party. Example of which is when failure by the insured to inform the insurer that he has been hospitalized for cancer or some other serious disease. Concealment vitiates the contract of insurance and entitles the insurer to rescind, even if the death or loss was due to a cause not at all related to the concealed matter. This is the rule whether the concealment is intentional or unintentional. To get my services as your financial advisor, you can reach me out on this number, 0926486938, or email me at ifprimefinancials1000@gmail.com to buy this insurance. Sign up here, tinyurl.com/buy-now-live-insurance if you think that the contents of this video helped you in any way. I would appreciate it if you can like, comment, subscribe and share my vlog with your social media pages, especially with your friends, family, and colleagues. Your simple act will truly be appreciated. Thank you.